Gold has been well supported by central bank buying. China bought some more gold last month. That's in March. It was less than usual, but they bought gold nevertheless at an all-time record price. All the evidence is that central banks who are buying gold don't really care what the price is. They just want it. And I think the recent events with the tariffs will only accelerate the desire of central banks around the world, whether they be friends or enemies of the United States. It will accelerate the desire to have more choice than just US treasuries in their foreign exchange reserves.
Gold has solidified its reputation as a premier safe haven asset, with recent price surges reaching unprecedented highs above $3,200 per ounce. This impressive performance underscores gold's remarkable resilience, particularly in market volatility. Unlike the crashes experienced in 2008 and 2020, where asset prices steeply declined, gold has rapidly recovered from initial sell-offs triggered by tariff-related concerns. This swift rebound highlights its strengthened position in the global financial landscape, making it an attractive option for investors seeking stability during uncertain times. Clive Thompson, a seasoned market analyst, points out that central bank gold purchases have become a significant driving force in this market trend. Central banks worldwide are actively exploring alternatives to the U.S. Treasury bonds, driven by concerns surrounding America's fiscal trajectory and the increasing politicization of dollar-denominated assets. As Clive Thompson highlights, countries that have historically held minimal gold reserves, such as Canada, are now beginning to diversify their holdings, recognizing the need to adjust to a more multipolar financial system. This shift toward gold and other tangible assets is part of a broader strategy to hedge against potential US dollar instability and position themselves for future economic shifts. As a result, central banks are recalibrating their reserve policies, seeking a balance between traditional assets and physical commodities like gold and silver. In addition to central bank purchases, strategic buyers have noticed a noticeable increase in taking physical delivery of 100-ounce gold bars, each valued at over $300,000. This shift toward physical ownership, rather than relying on paper claims or derivatives, highlights growing concerns about counterparty risk and the stability of financial institutions. Amid economic uncertainty, these buyers turn to tangible assets for greater security, reinforcing gold's reputation as a critical store of value in times of financial stress. Now, we present the clips from Thompson's interview. Before we continue to discuss this, please subscribe to our channel and activate the bell icon for timely updates. Thank you, and enjoy the video.
Gold has been flying because the asset allocators are now starting to redo their sums, and they're saying, what would have happened if we had an allocation of 2% or 5% to gold? And the maths says that would have reduced risk, reduced volatility, and improved returns. So asset allocators, for the first time in decades, are starting to add gold back to the portfolios. And we've seen in the last few weeks that gold has, in fact, been flowing into the gold ETFs, whereas for a few years, the quantity of gold in terms of tons in the ETFs has been going down. Now it's starting to rise. The feeling is that the man in the street is starting to buy gold, both physical gold and going into the ETFs. Now, probably this is the first time you've heard me say it, because I've been constantly saying this gold rally is not the man in the street. It's been central banks and large strategic buyers, the sort of buyers who are able to take delivery of 100-ounce bars out of COMEX. Now, 100-ounce bars, we're talking about $300,000 or something like that. It's a lot of money. These buyers were not mom and pop, but I think mom and pop is starting to come back into the market, but only very tentatively at this point. I think that is why we've seen the gold price, because it takes a very small amount of money to move the gold price and the gold mining sector. I mean, we're looking at the gold mining sector. I looked today, GDX, for example, that's the ETF, which tracks the largest gold mining companies, up 5% on the day. So people are starting to think, how can I get exposure to the gold market? And I think that's coming back now. When I first arrived in Switzerland in 1985, it was fairly traditional. Every portfolio in a Swiss bank would have about 5% exposure to gold. But as the years went by, that exposure started to drift down, particularly from the year 2010 onwards. So gold was very, very strong up until about 2010. It had gone from almost, under $100 up to over $1,000. And then from 2010, it didn't really do very much for another decade. As that decade was passing, stocks were performing extremely well. So money was coming out of gold all the time and going into stocks. So by the time I retired, which was 3 years ago, the official allocation of the bank where I worked and many other banks to gold was actually zero. Now, we had in terms of investment management, we had a tolerance of 5%. So you could actually get to your 5% gold if your clients believed in you believed in me, and they did. So we actually had a little bit more gold than we should have done according to the asset allocation tables, which should have been officially zero. But those numbers are now starting to come back. I got an email from a Swiss bank just probably 2 days ago, which it was, when I say it was an email, it was a PDF investment recommendation report, 2 pages of what we should be doing about tariffs. And then right on the last line, they sort of added as an afterthought, another way to sort of protect yourself is to have some gold in the portfolio. And it was almost like an afterthought. So it's coming. I think the gold is coming into portfolios. And so I believe we probably have a long way to go, not least of which because the central banks are probably likely to be buyers more than ever. I mean, if you think what's happened in the world, we've had these very aggressive and surprising tariffs, not only on people or countries which Mr. Trump sees as his enemies, but also on countries which are supposed to be friends of the United States. Take Canada, for example. Very aggressive tariffs put on Canada, and Canada has retaliated. And 2 countries which love each other and at total peace suddenly are having a spat over tariffs. Now, what's Canada saying? They're saying, well, I don't know what they're doing, but they must be thinking, can we trust what's going to happen next out of the United States? They punished us once, are they going to punish us again? What about all these treasury bonds we're holding? Now, Canada does not hold any gold, but it wouldn't surprise me one little bit if they're now rethinking that, and maybe they're one of the buyers of gold, which we don't know yet. We'll know that in a few months when the figures get reported. Gold has been well supported by central bank buying. China bought some more gold last month. That's in March. It was less than usual, but they bought gold nevertheless at an all-time record price. All the evidence is that central banks who are buying gold don't really care what the price is. They just want it. And I think the recent events with the tariffs will only accelerate the desire of central banks around the world, whether they be friends or enemies of the United States. It will accelerate the desire to have more choice than just US treasuries in their foreign exchange reserves. For example, this week we've seen quite a big decline in the dollar. It's gone from, if we look at the Dixie, the DXY, which is the dollar index, it's gone from 103 to at one point below 100. It's slightly above 100 as I speak. And a few weeks ago, it was 109, 110. So it's come off quite a lot as people have been basically bailing out of the dollar. I think I don't think this is necessarily people selling as private individuals selling the dollar. I think it's more likely that central banks, again, are saying, why are we so exposed to the United States with everything which is going on? And they're probably investing in European central bank bonds. They're probably investing in British gilts, even Japanese bonds and Swiss franc bonds. And the reason I say that is we've seen in the last few days, quite a heavy sell-off in the US 10-year. We've seen the 10-year go from about 3.9% yield to 4.5% yield. It's just under 4.5, 4.49, something like that percent yield as I speak. So when the yields go up, that means the price of the bond is falling. So the US Treasury 10-year bond, the price is falling rapidly, but the prices of the bonds in other countries like UK, Europe, Switzerland, has not been falling in the same period. That's unusual because usually bonds around the world tend to be fairly correlated. They tend to move to some extent in tandem with you. I know I'm not talking about the long term, I'm talking about in the short term. Japanese excluded in that. So what that implies is that I think central banks are probably reducing their exposure to US treasuries and are probably increasing their exposure to other things, including bonds issued by other governments.
Clive Thompson is much more bullish on silver, as it currently trades above $32 per ounce, showing significant growth, yet still well below its all-time highs. This price point places silver in a unique position, balancing both investment demand and industrial necessity. Silver consumption has consistently outpaced mine supply for several consecutive years, resulting in a structural deficit that supports its price. Thompson emphasizes silver's growing role in the industrial sector, particularly within electronics and photovoltaic technology. He highlights that silver consumption has surged, with the electronics industry increasing its usage by 20% year over year. The photovoltaic industry, a key player in the rise of silver demand, contributes significantly to this growth. As the global production of electronic devices and solar panel installations continues to expand, the demand for silver is expected to outstrip supply, further tightening the market. Thompson believes that silver is on the verge of a significant breakout, but it must first surpass the $36 mark and remain above this level for a sustained period. Once this critical threshold is crossed, he predicts an accelerated rally could push the price toward $40 and beyond. While silver may experience short-term volatility, Thompson argues that this key price level will attract more investors, especially as the metal's supply tightens. Currently, silver is still under the radar for many retail investors, but once it crosses this crucial price point, Thompson expects it to garner significant attention, pushing its price even higher as investors seek to capitalize on its growing industrial and investment appeal.
When you impose tariffs on foreign nations, you buy less foreign goods. What does that mean? It means that you're sending less dollars overseas, and therefore your current currency should rise, not fall. But actually, it's falling. So what's happening is the currency is being overwhelmed by people who say, you know what, with everything that's going on, I don't trust what's going to happen tomorrow. No idea what's going to happen tomorrow. I have uncertainty. So they're selling US equities. They're taking that money home to their domestic currencies and basically selling the dollar. So at the moment, I think that's what's going on. There's net selling of the dollar because people don't know what's going to happen tomorrow. If you reduce your imports from foreign countries, you're paying less money overseas. Logically, your currency should rise, but that's not happening as we speak. So in answer to your question, do I think the dollar index is going to go lower or higher? I'm sort of sitting on the fence. It could go either way because we got these two pulls going in opposite directions. I've seen countless people commenting that gold has reached a certain level, $34, $33, $35, which they kind of see as a trigger point for the bull rally. I think we're going to have a rally, but I think the cutoff point where it starts to accelerate is somewhat higher than that. I'm talking north of $36 somewhere. But if we get above $36 and stay there for a few days, I think it's an easy ride up to 40 and beyond. Silver, of course, is going to be supported in the medium term by the simple fact that the mined supply of silver has been declining for a decade or more, and the consumed supply of silver is rising fairly rapidly. The biggest consumption of silver, or the fastest increase in the consumption of silver, is coming from the electronics industry. Now, I know, and you know, that there will be more electronic goods on this planet next year than there are this year, and that's going to consume a lot of silver. So the estimates were that last year the electronics industry consumed 20% more silver than the year before. That might have been 23 to 24 or 24 or 23, 22, I can't remember now. But certainly the Silver Institute was saying silver consumption is rising by 20% a year. And of course, the biggest component of that was the photovoltaic industry. And I've got a strong feeling that photovoltaic sector is growing quite fast. I mean, I'm getting far more knocks on my door than I've ever had from people trying to sell me solar panels on my roof. So I think it's become quite a mania in that area. But certainly the fact is, silver consumption is rising. We've passed the point where the consumption exceeds the mined supply a couple of years ago. The deficit's getting larger. The silver price has risen from around $20 to around 30 something, which it had to rise to suck out the scrap silver to fill the difference. And I think as that difference is going to get larger in the next year, probably the silver price has to go higher. But I don't think it accelerates away until we're above $36. I think it will just drift. It'll have its bad days and its good days. Nothing goes in a straight line. But we need to see it go above a certain level before it starts to suck in investors who say, I think I'd like to have some of that in my investment portfolio. I don't think there's a great deal of interest to buy silver bullion amongst the general public. I mean, the people who watch your show, they're intelligent people, so they're doing it. But there's an awful lot of people who just have no clue what the price of silver or gold is. I see that every day when I talk to my friends.
With global geopolitical tensions and economic uncertainty rising, the gold market is expected to continue its upward trajectory. Central banks, particularly in emerging economies, are likely to maintain or even increase their gold acquisitions as a strategic move to reduce reliance on the US dollar and secure their financial future. Even as prices reach record highs, China's ongoing purchases highlight its long-term commitment to hedging against dollar-based instability. With the annual gold supply remaining relatively fixed, any increase in central bank demand could significantly impact prices, making gold an even more attractive asset for investors looking for stability in turbulent times. Similarly, the silver market is also poised for significant growth. Market analysts have pinpointed $36 as silver's critical psychological and technical level. If silver breaks through this resistance point, it could trigger a surge in buying activity, with momentum investors and technical traders entering the market. That's it for today. Share your thoughts on Thompson's analysis in the comment section below. If you find this video informative, don't forget to support and turn on notifications to stay informed about our latest videos. See you in the next video. Thanks for watching.